challenging the assumption we're taught that economic crises are accidents, unexpected failures caused by greed, bad luck, or poor regulation, moments when everyone loses. But here's the mystery. If crises hurt the economy, why do the same groups always emerge richer afterward? Why do fortunes expand while wages shrink? And why does every collapse seem to quietly transfer wealth instead of destroying it? Because history suggests something unsettling. Economic crises don't just happen to the system. They happen inside it, and someone always knows how to benefit. Setting the stage, history and financial architecture. To understand this pattern, we need to step back and look at how modern financial systems are built. For most of history, wealth was tangible: land, gold, labor, goods. Losses were visible and immediate. If a harvest failed or a merchant collapsed, wealth simply disappeared. That changed with the rise of modern finance. Banking systems, credit markets, and eventually central banks introduced something new: financial abstraction. Wealth could now exist as numbers, contracts, and expectations. And when wealth becomes abstract, losses don't vanish, they move. This is where crises stop being random and start becoming mechanisms. Origins: how crises became opportunities. The modern crisis pattern begins when debt and leverage enter the picture. Borrowing accelerates growth, but it also magnifies fragility. The more leveraged a system becomes, the more sensitive it is to shocks. Banks lend aggressively during good times. Asset prices rise. Confidence feeds on itself. Eventually, reality intervenes. Defaults increase, bubbles burst, and markets panic. Here's the key cause and effect shift. Those closest to the flow of money see the danger first. Those farthest from it feel the consequences last. Crises don't arrive evenly. They arrive in waves of information. The rise who positions early. As financial systems grow more complex, so does insider awareness. Large institutions, hedge funds, and central banks have access to real-time data, liquidity tools, and policy influence. When instability appears, these players don't wait. They move capital, hedge risk, buy insurance, and position for volatility. Meanwhile, ordinary people remain invested through pensions, savings, housing, and jobs long after warning signs appear. By the time the crisis becomes official, the exit doors have already closed. Crises reward proximity to power, not productivity. Breaking point: the moment of collapse. When the system finally breaks, panic spreads. Markets crash. Credit freezes. Asset prices collapse. This is where the wealth transfer accelerates. Assets don't disappear, they become cheap. Those with liquidity step in and buy what others are forced to sell. Homes, companies, stocks, and entire industries change hands at a discount. At the same time, emergency policies are introduced, interest rates fall, money is created, bailouts are deployed. These measures stabilize the system, but they also inflate asset prices after the crash. Those who bought at the bottom benefit most from the recovery they helped shape. Fallout after the crisis ends. When the headlines fade, the damage remains uneven. Workers face unemployment, wage stagnation, and lost savings. Small businesses struggle to recover, but asset holders see a different outcome. Stocks rebound, real estate rises, corporate consolidation accelerates. Crises shrink competition. Fewer players control more resources. What looks like recovery is often concentration. Failed fixes why it keeps happening. After every crisis, reforms are promised, new regulations, new oversight, new safeguards. But the structure remains the same: debt-driven growth, asset-based recovery, centralized intervention. Because the system isn't designed to prevent crises, it's designed to survive them. And survival often requires sacrifice, just not from those at the top. Modern parallels the repeating pattern. Look at recent history. After major crises, wealth inequality widens. Asset prices recover faster than wages. Central bank balance sheets expand. Government debt rises. Each cycle ends with fewer owners controlling more value. The pattern isn't hidden, it's normalized. Crises have become economic reset buttons. Not for everyone, but for those positioned to press them. Takeaways plus warning plus call to action. Here are 3 truths history makes clear. First, crises don't destroy wealth, they redistribute it. Second, information and liquidity determine who wins. Third, recovery often benefits asset holders more than workers. The warning isn't that another crisis will come, it's that when it does, the outcome may already be decided. The real question is whether people will keep mistaking these events for failures, or finally recognize them as features of the system itself. If this helped you see economic history differently, subscribe, because understanding the pattern is the first step toward not being crushed by it.